What's going on, YouTube? We are going to talk about Adobe, ticker symbol ADBE. In this video, we are going to go through most recent financial statement. They just reported their earnings, so we'll take a peek at those real quick. And we want to take a look at their overall bigger picture of how the stock has performed over the course of many years. And then after that, we're going to hop over into the valuation spreadsheet and figure out what an acceptable buy price is for Adobe. Last but not least, we'll take a look at the stock chart and kind of see where price action might be headed. So we're going to begin here with Adobe. We got year to date. This company's up basically 57% over the course of 1 year, 71%, 5 years up 97%. So Adobe reported their earnings last week on the 14th. They beat on their EPS and also revenue by $22 million. So since they reported earnings last week, we got some new financials to look at. We're going to stick over here on the 9 months. So we got total revenue is up 9%. Our cost of revenue is up 7.2% in the last 9 months. Operating expenses up 11%. Good thing on this, though, you can see is it's mostly under sales and marketing and research and development. G&A did tick up a smidge bit more than what you'd probably like to see. Net income up 9.3%. We also see that there must be a share buyback program going on because we are now down on share count, which is awesome. One thing I noticed that I'm not a big fan of is why we're reducing our short-term investments, because typically this gives us a significant amount of interest income unless they have a plan for that money going forward, then that's different. But if they don't, I don't know why they got to keep $6.6 billion on the balance sheet when they could invest it to make more, to generate more money. Total current assets, although is up 13.6%, it is up. Our cash is up $1.5 billion, so it's something to kind of take a peek at too, just to see where that potentially came from. But overall, the debt to assets is nicely balanced. We've got $29 billion in assets, and overall, we've got $21.6 billion in debt. And a good portion of that debt is also in deferred revs at $5.4 billion. So, realistically, we're sitting at about $16 billion in debt with $29 billion in total assets. We also have about $32 billion in retained earnings, which is another reason why I wonder why we have so much cash just sitting right there. Although stockholder equity is up, our net income flows over to here to our cash flow statement. We can see we're still handing out stock-based comp. Gives us a net cash provided by operating activities of $1.89 billion. And we take out our capex of $91 billion and gives us, or sorry, million, and gives us a free cash flow over 9 months of $1.782 billion or basically $4 billion in free cash flow annually. So very healthy on the free cash flow side of things. And we can see here we are buying back shares. So yes, we handed shares out, but we're buying back more than what we handed out. So that's always good. So we added 1.14 billion dollars to our previous $5.4 billion, and now we're sitting at $6.6 billion in cash and cash equivalents. So now let's take a quick peek at the overall how this stock has performed over the course of years. So we're on the income statements here, and this is annually. We can see our revenue growth has been growing. This is 22, 24, 23, but it is beginning to slow down a little bit. Although it's not, this could just be a bad year, right? Because we've been very consistent at our low 20s here for many, many years. We had one, 2020, very kind of obvious why that's down. In 2021, we picked back up. Kind of obvious why 2022 is down as well, because things are, people are cutting costs in certain areas. So it kind of makes sense. Come down here, down to net income. This is the one thing I did not like for sure, is to see we have 85, 45, 53, 14, 78, -8, -1. Although this right here is probably a big reason we had a big jump from 2.9 billion to 5.2 billion. And then that kind of skews these numbers quite a bit, right, on the percentage side of things. Although, basically relatively flat in net income. We can see right here, that is mostly why we had such a big difference, a 78% increase in net income growth. It's because they had some sort of tax benefit come to them. And so we, instead of taking away, let's say $800 million or whatever, we now added basically $1.8 billion, you know what I mean? So that kind of really throws things off in the terms of net income growth here. So initially was like, don't like that until I dug into it a little bit there and you could see, oh, okay, well, that's why. Balance sheet, our cash growth, you know, I don't really care about the percentages. I just care to see how our cash is sitting, and it doesn't seem like we went from 20 billion down to $6 billion. So cash is good for me. Our debt growth relatively flat. We can see, I mean, it has grown, but it's not out of control. Then over here to our cash flows, our operating cash flow growth is beginning to slow based on percentages. Although you look at it, it is still growing. We had a big jump, $2 billion increase almost there. And then now we've slowed down in 2022, obviously. Again, it makes sense. Our capital expenditures are not going out of control either. And overall, that gives us a free cash flow, a very nice growing free cash flow. We can again see this year just seems to be just, one of those, it's going to be like a 2020 kind of year where, people are cutting costs on certain things, and Adobe might be one of those places where they're cutting a little bit of costs, and that might pick back up. We'll find out. But we can see 7.3% of free cash flow. We're starting to, currently things are slowing down in the company, but nothing to be concerned about yet. I pulled up all the ratios for Adobe. The one that really matters to me personally, obviously you can take a look at all these other ratios if there's some that appeal to you, but we can see our return on invested capital has been, over the last of many 4 years here, it's been very good. Upper 20s, mid to upper 20s, and now this year we're sitting at 6.5% return on invested capital. So again, we can just see a big just slowdown in this company just based on its numbers, right? The company's not slowing down over years. It's just having a year which makes sense for it to have a slowdown, right? So that return on invested capital, obviously, we can see is not at our 15% that we want, and our return on equity, same thing, sitting at 9% there. Our market cap on Adobe is $241 billion. There's no dividend payout on Adobe. We have analyst price target of $550 per share, which gives them they're forecasting 11% revenue growth and 20% earnings per share growth rate. Under the Peter Lynch evaluation, for some reason the ROI is not popping up there, but we know what it is. We've got our EPS, we've got our forward EPS growth rate, our PE ratio, and our forward revenue growth rate. And that gives us a Peter Lynch fair value of $323 per share. We have our multiples to compare to. The only one I might pull out of here is CRM because our PE is 134, 100, so let's see what that does. So that brings us down to 593. That, a PE of 130 something is just not something worth comparing to. Although these other PEs here are incredibly high compared to where we're at. We're sitting at a PE of, well, it says 48. you know, we're on the lower end of most of these here. We're second in line in terms of bottom. So kind of something to pay attention to, that our peers are trading at a higher PE than what we are as Adobe, I should say. Our manual PE, our market cap, cash equivalents, our debt, cash from operations gives us only 10 years until we can earn our current market cap, which is really good. Our price to book, we are trading at double our normal trading price to book. Our PEG ratio currently is sitting at 3.92. The forward PEG, for some reason, we don't have our forward PE ratio, but that's not really a big deal. Actually, it's not going to impact anything at all on the rest of these valuations. Intrinsic value on our Grams valuation is $371 per share. I gave this a 1. It is still relatively a strong growing company. It could be a 0. However, a 0 is going to bring the price down quite a bit there. So I'm going to leave it at 1. We're still growing. Our EPS's growth rate is above 20%, which above 20% should be a 0, but I'm going to give them a 1 because they're a little more of an established company. We get a weighted average cost of capital of 9.21%, perpetual growth rate 2.5, our free cash flow growth rate of 8.5%. We can see here our free cash flow, which we've already looked at, is growing and growing and growing and growing, going in the right direction. Good to see. Cash and marketable securities, 7.5 billions. We now have a DCF price per share of $280. Rule 72, EPS 1111. Current PE 47.62. Our lowest EPS growth rate was 13.4. So I put 13.4 for our forward-looking growth rate. 13.4 goes into 72. 15, or sorry, 5.3 times. That will double our EPS once, and then another time 0.86 times. So one time is 22 and not quite a second time. So that gives us just shy of 44. So I put in 40 for our future EPS. Gives us a fair value of $268 with a 30% margin of safety, $187 per share. So the overall summary here on Adobe for our price, we have an average price of $367 with a purchase price, which has 30% margin of safety tied to it, is $257 per share. So, you know, we can see all of our financials look really good. We overall the company is in a little bit of a trough, right? We can see that in all the financials, big picture of all of them. We can definitely tell that this company is currently, I wouldn't say struggling, but they're not where they should be, right? We can see our subscriptions from last year to this year have picked back up. So we know 2022 was low, right? And we just increased our subscriptions in the last 9 months by $1.4 billion. So it could give us a good sign into the future to tell us that our subscriptions are starting to tick back up and that we might be headed in the right direction again, moving into 2023, fiscal year 23. So this is our third quarter of 23. So they got one more quarter. Last but not least, we're going to take a peek at the stock chart here. Overall, we got this long-term trend line. I don't know if this is something that's worth trading off of because I mean, it obviously clearly broke through it. It seemed to show some sort of resistance and support area here for a hot minute, and then ultimately it broke through, retested it, broke down even more. We've got this macro trend line, uptrend line here. That could be another area where it could pull back to that line. I see a potential support line right here as well. But other than that, I don't see a whole heck of a lot. You could also call this support. Maybe that's resistance. That's very possible. But overall, we can definitely see based on our valuations and based on where technicals are at, companies overpriced, right? We've got 5 different valuations coming in telling us that the average price of this company right now is $367 per share. That's what it's valued at today. Does it mean it's not worth $500 a share? No, it absolutely could mean it's $500 a share. To me, it seems like it's very overpriced. That's how the stock market works. Stock market never makes sense. But that's it for Adobe. If you found value in this video, drop a like, subscribe, and we'll be back later with another stock analysis video.